talk about mastering the time value of money. How, once you understand the time value of money, is going to give you a financial edge. Today, we will understand how the rupee today gives more value as compared to the rupee tomorrow through its earning potential and to inform cash flow. Now, why is it that money today is more valuable? The reason is as the time grows, the value of money decreases. So if we have 100 rupees today, it will have more value than 100 rupees 5 years from now. But what is the reason? Why is money more valuable today than tomorrow? Because normally people prefer current consumption. The individual choose to use money now rather than delay spending. If you invest money today, it will earn its return than if you invest the money tomorrow. Also, the future cash flow lose the value when discounted. We all know that there is a certain rate of inflation which eats the value of money. What 100 rupees will buy today, you will not be able to buy the same amount of quantity of any product or service. 5 years from now, you'll have to pay more. For example, if today you're getting 5 apples of rupees 100, tomorrow you may get only three. So the purchasing power of the money reduces. Also, the present inflow gain value when compounded. As you know that current cash flow will grow larger when compounded over a period of time. So in order to understand how exactly this entire process works, we have a concept called present value or future value. But the use of this term, we calculate the value of money in the future or the value of future money at present. These two terms are called present value and future value. So let us first understand what are the parameters in time value of money. First is cash flow. It is the amount that comes in through your salary, through your income. Rate of return is the discount rate or the compounding rate which you normally get on your returns which you keep in your bank. Time is the number of years, months, and quarters. Any frequency you want to choose. And frequency is the cash flow, how it occurs. Let's suppose you're getting monthly salary. So the frequency will be monthly. Similarly, if you're getting a lump sum payment on yearly basis, it will be yearly. If you look at the formula of present value is equal to future value 1 plus r to the power present value. This is just for the sake of calculation. And if you use the formula to calculate the present value of 50,000 rupees after 5 years at 6% discount rate, it will come to around 37,362 rupees today. So if I put money of 50,000 rupees today in a bank account, 5 years after, the value of same 50,000 will be 37,362. So the value of money decreases. This is very, very important to understand. As the number of year passes, and once you apply the discount rate or inflation rate, you will find that the value of money will decrease. Now, what will happen if we project future value? We want to understand how much 5 lakh rupees will be after 5 years. This we can calculate through future value. So, the formula of future value is there in front of you. More frequent compounding, wherein if you are compounding it quarterly or yearly, the future value increases. Why? Because there is interest on interest. So if I give an example of 5 lakh rupees at 8% for 5 years, it will grow to 7 lakh 34,664 on a yearly basis. And if it is getting compounded on quarterly, this amount will increase to 7 lakh 42,974. This shows the compounding impact. We have just taken an example of quarterly and yearly rate of interest through compounding. So what we have learned, how to calculate present value, how to calculate future value. Now let's talk about the rate of return, which is CAGR. Now this is the annual growth which we calculate of any investment. So CAGR will calculate the annualized return over multiple period. We have the formula of CAGR. CAGR is used to compare returns across different investments or time frame for informed decisions. For example, your 100 rupees will grow to 120 in 2 years, which will give a CAGR, that is compound annual growth rate, of 9.5%. This shows that there is a growth in my investment. The CAGR is increasing by 20%. So let us calculate and manage periodic payments with the concept of present market value. Now you can master EMIs and SIP calculations to plan loans and investments effectively. Periodic payments like EMIs and SIPs help manage loans and investments systematically. You can use this parameter to calculate how much you are going to pay in the future. For example, a 30 lakh loan has 6.5% interest for 20 years. This will give you a monthly EMI of 22,367 rupees. So always evaluate affordability and sensitivity to interest rate charge before committing to any loan or SIP. Now let us quickly learn and understand loan period, how we are going to determine in how many years the loan will get over. This is something which we can calculate it through total number of periods needed to fully repay a loan based on payment size and interest rate. You can use the Excel formula written there to calculate the loan tenure. For example, a 5 lakh rupees loan with 12,000 EMI at 8% interest will require around 49 months to repay. So this helps us plan our finances and any major decisions on how our EMI and interest will affect the loan duration. Also, perpetuity, which is a concept that we are going to discuss later. But let's first talk about annuities. Now, there are two types of annuity. One is ordinary annuity and the other is annuity due. Now, ordinary annuity is when payments occur at the end of each period. An annuity due is when the payments occur at the start of each period. You can use Excel functions when calculate the ordinary versus annuity due. For example, 5,000 rupees for 4 years at 10% interest will yield the present value of 15,849. Now let's talk about perpetuity. Perpetuity is the amount of money which you are going to get for your whole life without an end. It is normally used to calculate pensions and regular cash flows. It is a cash flow that will continue forever with no end date. And this is how you calculate the perpetuity. We have the time value of money, the concept originating from the history of 7,000 years to ancient Mesopotamia and Egypt. Early lenders, such as farmers, used the time value of money to make transactions. Over centuries, this concept evolved into a fundamental pillar of modern finance, which supported lending, investment, and valuation worldwide. Thank you.